The struggling European economy is again under scrutiny after the decision by Standard & Poor's to downgrade the credit rating of 9 of the 17 Eurozone economies. Austria and France, which is viewed as one of the stronger countries in the monetary union, were stripped of their AAA status. And the investment grade of Portugal and Cyprus is now classified as junk. For his insights on these developments, I spoke to author and global finance specialist Satyajit, who in 2006 predicted many aspects of the global financial crisis. Satyajit, in a sense, these downgrades were expected. So how significant is this really?
Well, at one level, it's not significant at all because, as you say, they were expected. And for a country like France or for Austria, which is going from AAA to AA+, it won't have any material effect on their ability to raise funds or really the cost of their funds. But there's a second group of downgradings which is extremely important, and that is the downgradings of countries like Portugal, which has now become non-investment grade, Italy, which is now very close to being non-investment grade, and Spain, which is now only a single A. And for them, it's more important because their ability to raise money and the cost of that funds is under threat. But there are much wider ramifications of this which are affecting the bailout fund, the politics and all of those.
Now, what about the bailout fund? Because obviously France is a key player in that fund.
Well, the bailout fund was always very poorly designed because it was people guaranteeing loans to themselves, as it were. And firstly, the bailout fund had Spain and Italy, which were guaranteeing 30% of it, which was ludicrous because they would need to use the fund themselves. But it relied really on the core countries, which is France, Germany, Netherlands, Luxembourg, which were rated AAA. Now, obviously, 2 of those countries are not rated AAA. From what I understand, the fund itself will almost certainly be downgraded at some stage over the next 6 or 7 months. And under those circumstances, the ability of this bailout fund to raise money, to make the payments they've already committed to Greece, Portugal, and Ireland is going to be difficult. But more importantly, their ability to support the fundraising efforts of, say, Spain or in Italy is now limited. And this has caused an interesting ruction because obviously everybody recognizes this. And overnight, the Germans made it very, very clear that they did not want to increase their commitment in support of the fund because that was one of the options to get around this problem. And so these are some of the problems for the bailout fund. And the bailout fund's already in serious trouble anyway because they're having trouble raising money. And they've been very cautious about raising money for this reason.
You've actually talked about the European economy being a zombie economy. What do you mean by that?
Well, I think fundamentally it's a chronic disease that Europe now has. And there were opportunities along the way for them to do things to cure them. But now they're in this stage where they're basically hooked up to a machine which is going to keep them alive on a drip feed. And every once in a while, you'll get a major health episode and people will run around. But there's no cure underway. And under those circumstances, you're going to see the real economy, which is jobs, investment, production, slow down. And that is the key, in my view, to Europe actually getting out of this, which is growth. And under those circumstances, all the forecasts for Europe are catastrophe-like, simply because they're going into recession. And even Germany, which has been the powerhouse of Europe, is slowing. So basically, I can't see Europe getting out of this. They're going to be trapped in this zombie-like zone for a prolonged period, with very profound implications for the global economy.
Now, what about the implications for Australia?
Well, for Australia, there are several lines of connection. The first line of connection, I think, is trade. China's biggest trading partner is Europe. And obviously for China, the US is a very major trading partner, but the US's major trading partner is Europe. And the slowdown in Europe and the debt problems in Europe will certainly impact on the Chinese economy and therefore indirectly on the Australian economy. But also importantly, there are 2 other channels which are important to think of. One is the financial markets, the ability of companies in Australia and banks in Australia in particular to raise money. Because what we have seen is the financial markets pretty much seize up, not to the same extent as in 2008, but comparably at a lower sort of level of a degree. And under those circumstances, the Australian banks have to raise $80 billion this year. And the problem is $35 billion of that was previously guaranteed by the federal government. It's now not going to be guaranteed. And we are now seeing some difficulty for these banks in raising money, certainly in terms of both availability, but in terms of cost. The cost of money for Australian banks has gone up quite staggeringly since the middle of last year. And that will flow through eventually either into availability of credit or into the price of that credit in the domestic market. Australian companies also have to raise about $80 billion this year. And what is often not recognized is European banks, which have serious problems now because of their exposure to the European sovereign debt, are now actually shrinking. They're not making new loans and they're trying to sell existing loans. And they constitute roughly 30 to 35% of all lending in Asia Pacific. And so we expect their share to drop quite dramatically. And under those circumstances, that will affect the supply of credit to Australia. And the last issue is currencies. The euro has declined by close on 12 to 15% against the US dollar and also against the Australian dollar, which means Australian export is not competitive against Europe. And the other thing is it also makes for outbound, like tourism. We're not going to be able to attract tourism. Instead, Australians are going to go overseas. And what at the heart of this currency problem lies is a potential risk, I don't know how serious it is, of a currency war. Because everybody has been trying to devalue their way into some sort of growth. But the problem is the US benefited when the US dollar weakened, but now it's strengthening. So what we may see is what the Brazilian finance minister called very prosaically the currency wars. And that could complicate a very fragile global recovery.
What do you think about the comments made by Prime Minister Julia Gillard today when she basically said that the problems in Europe are occurring because they didn't do what we did?
Well, I think she's being a little disingenuous. The problems in Europe are far more complex than the problems we faced. And one thing I would say is it took us 17 years as a country to regain our AAA rating. And if it takes Europe that long to regain their AAA rating, we're in for a very rocky ride.
And you do paint a grim picture. You obviously believe that the way they're trying to solve this problem clearly isn't working at the moment, and you don't see any sign that they've figured out what to do.
Well, I think there are some things on the table which would work, but they need to essentially be implemented very aggressively. The first thing they have to do is some of these countries like Greece, Ireland, Portugal, and perhaps even Spain and Italy have to basically write down their debt, which means somebody's going to have to take the pain, which is the people who've lent them the money, which actually are French and German banks. And then you have to recapitalize them. So France and Germany would have to find the money to put money to replace these losses. And they have to do the other things they're doing, which is get their public finances in order. They then have to become more competitive in terms of as an economy by changing labor laws, all of that. But it's a very long, slow process, even if with the best intention you start to do that. But they haven't even got to the point where they're actually dealing with these issues in a concrete way. And there are huge divisions politically between the countries, but also between what I would call the Eurocrats at the European Central Bank and the politicians. So they, to be very honest, haven't really got to the stage of diagnosing properly, and they're certainly doing only half-hearted treatments. And I think that means that we are going to be trapped in this for a very prolonged period of time.
Satyajit Das, thank you very much for speaking to us.
It's good to be with you, Tracy.